Hello and welcome to yet another quick video. Its purpose is to prepare you for the period lasting up till FOMC. It will be pretty clear what I mean by this key fact not to miss. I'm pretty sure you know my site and the screenshots and whatever I am doing extra behind the scenes for clients. So even if you are not even a free client, free subscriber to the daily mailings, you are doing yourself a great disservice. The same is true regarding subscribing to this YouTube channel, because you have noticed that I have kind of returned and I will be doing more of these ad hoc videos seeking to prepare you for key turning points ahead and commenting on what I see unfolding in the markets as we speak, so it will be pretty relevant. So turn notifications on. Thanks for liking, subscribing, commenting. Let's now dive into the charts. The first one I'm bringing you is the 4-hour ES1, and it's not exactly apparent from this chart. I will show you one more, but we are now at the Friday's non-farm payrolls release figure when it comes to the S&P 500. As you can see, it's pretty much directionless, trendless, and as I had been saying on Twitter, we are range bound. I have even opened a poll late yesterday, and thus far most of you are leaning towards breakout either way of the recent range, which is not totally the position that I'm sharing, because most of the price action will be captured within the extremes given within the poll. So I'm pretty sure that you have seen it and hopefully voted as well. And the point is that today we are going to start seeing more of a clear positioning when it comes to rate cuts and FOMC next week. The following chart is the Nasdaq one, and you see clear outperformance, and this is what I had been talking about since well midweek, past week. And it is that Nasdaq is leading. But what is leading? Semiconductors? They are not making too much progress. Nvidia? Neither. IGV recently driving back its strong upswing. Dell, after earnings, when it's laying off almost 15% of the workforce in a supposed AI boom, not exactly. So what has been the new lifeblood to tech? It has been AVGO earnings yesterday, and these will have positive implications, I do think, as well today after the open. So the clear outperformance of Nasdaq over S&P 500 is apparent, and as it so often stands, it's a sign of bull up-leg, no matter how compressed and trendless S&P 500 currently is. What else? The next chart is the Russell 2000, and as you can see, small caps are not really making any progress. Actually, till from the moment before CPI release, the preceding day, when its upswing was quite immediately rejected, which is what you see on this chart clearly as well. I had been bearish or exactly not at all bullish small caps, and this has interest rates reasoning. We see rate cut expectations being dialed back. Okay, it's all fine and dandy that December rate cuts are going up these odds, but January not so much. March, that would be the latest fear, whether the Fed cuts in March or not. It's not yet top of everyone's mind, and it might not even become so in the weeks ahead, but disregarding would be at one's peril. The point is, though, that January, which had been expected 25 basis points, is no longer as certain. Yesterday, as I commented on Twitter and as clients knew first before anyone else, it's been the double whammy of very hot producer price index and unemployment claims approaching 250,000 on a weekly basis. With PPI closing at 3% year on year, that's not at all a good sign for rate cutting ahead when it comes to Fed monetary policy. And this is what small caps have been and are telling us, especially with yesterday's breakdown. This is nowhere near Friday's non-farm payrolls levels. It has, of course, these two latest data that buck the trend of positive economic surprises. These, while they have not yet caught up with consumer discretionaries, and they would probably not, and next week's retail sales data would confirm that, because that's the hard data, and we had already soft data of consumer confidence, which had not been poor at all. But when it comes to corporate earnings, this leaves little room for error, and the expectations for the quarters ahead is quite high. So that's why you see home builders, real estate, industrials, whereas fintech names, financials, whether it's XLF or KRE, going down and tame. This is not good. These are interest rate sensitive sectors, and you see US dollar going up again. This all ties well to the bottom in yields that I saw for the 10-year developing between 4.10 and 4.20% that I had announced weeks ago. Regular readers of the daily analysis know all these facts. And final note regarding this chart is that expect FOMC next week to be more important than the retail sales outcome. Now there comes the chart showing how directionless, how motionless S&P 500 is. It's now precisely at the December 6th level of non-farm payrolls, just illustrating that the index is not going anywhere and we are seeing just rotations still in the spotlight, and they are going out of the interest rate sensitive sector's favor. Contrast that with Nasdaq 1 hour chart, which you see very clearly above the corresponding non-farm payrolls figure. So we have this leadership even if semiconductors are tame and IGV is undergoing correction. So be ready, this is Friday, options expiry, and positioning for FOMC is starting. You know my join page that will help you select the correct product, how to make the most of what I do for you, including one-on-one support behind the scenes. So go through the opening part. Forget not that the intraday channel contains more crypto coverage, and side terms apply, and I look forward for interactions with you, whether on Twitter or on Telegram, and make the most of this YouTube channel as well. Finally, disclaimer, have a great day and upcoming weekend, and talk soon again.